Good morning, everyone. Good morning, everyone. Welcome to this fine Monday morning. And I welcome you to our weekly market outlook with me, Geoffrey Gishanga, educator and market analyst at Scope Markets Kenya. So, welcome to this weekly market outlook where we get to look at the previous week, the highlights of the previous week, where we had the various events and fundamentals that took place in the last week. We look at their trading implications and their market reactions, and also now we get to look at what we're expecting for this week. So last week we had quite a number of events from the Canadian CPI. We had the New Zealand monetary policy statement being released. We also had the UK CPI as well being released within the week. We had also the FOMC meeting minutes where the Fed gets to discuss about the previous FOMC, and they get to talk about their stance on rates and also inflation. We also get to see the Jackson Hole Symposium happening last week. It was a 3-day event that happened last week, and that was when we saw Powell also give the Fed Chair Jerome Powell give his speech. Then we also had earnings on. We had also various corporate earnings from Target, Walmart, and yeah, we had the Target and Walmart. And the highlight of the week being the event we had here at the office on Friday. It was a very great and amazing event. A huge shout out and thank you to everyone who actually came and had a great time with us. So that was the highlight of the week. And so let's get to the details of looking at what exactly happened within the various fundamentals and how it affected the various currencies. So welcome on board, and let's walk together through this. So starting off, we had the Canadian CPI. So the Canadian dollar weakened to its lowest level in nearly 3 weeks against the dollar, pressured by falling oil prices and weaker domestic inflation. So on Tuesday, the Canadian dollar fell 0.4% to 1.3855 per dollar. So touching its weakest intraday level since the 1st of August at 1.3860. So the development is that the Canada's annual inflation rate eased to 1.7% in July, down from 1.9% in June. Then the decline was mainly driven by lower gasoline prices. The Bank of Canada key measure was that the 3-month annualized underlying inflation fell to 2.4%, down sharply from 3.4% in June. So these developments have heightened expectations of an upcoming rate cut by the Bank of Canada later on in the year. Not yet decided when, but later on within this year. So let's wait and see if we will actually see by the close sometime within this year, we will see a potential rate cut by the Bank of Canada, something to closely observe and see. Then coming into the New Zealand monetary policy. So last week, the Reserve Bank of New Zealand released their monetary policy statement, and they reduced their rates by 25 basis points to 3%, marking a 3-year low. Okay, so the central bank's policy stance is more dovish than markets expected. So the forward guidance is that the official cash rate, which is now the interest rate projection for end of 2025, is 2.71%, and previously it was about 2.92%. Then you have the projection for early 2026 is 2.5%, and previously it was about 2.85%. So what do we get from this information? This is what we get. We get to see that this indicates a longer easing cycle ahead, reflecting concerns of a slowing domestic growth and inflation pressures. So recently, we've seen most central banks cutting their rates. We saw the Bank of England. We saw the European Central Bank. We've also seen now the Reserve Bank of New Zealand. So we also saw the Reserve Bank of Australia as well, sometime about a week or two ago when they released their monetary policy statement. So we are getting to see most central banks cut their rates. Now the most anticipated is definitely the Fed, because again the pressure of cutting the rates has been piling up on the Fed for quite a while. But we can only wait until that time that it actually happens to be able to see the reaction. For now, it's more of forecasts and speculations around it. So let's be patient and get to see, will we actually get to see that rate cut happening in September? Or will we probably see the Fed maintaining their rates? So we will get to also talk about that as we get to talk about the FOMC meeting minutes that happened last week as well. So coming into the UK, so we have the GBP Consumer Price Index that happened as well. So the CPI rose 4.2% year on year in July, up from 4.1% in June. And the CPI headline measure rose 3.8% year on year, accelerating from 3.6% in June. So the monthly performance, the July CPI rose 0.1% compared with a negative 0.2% decline in July 2024, that is last year. So the inflation momentum remains persistent, raising concerns about the Bank of England's ability to ease policy in the near term as well. Okay. So we have that from the Consumer Price Index in the UK. So we can definitely see inflation momentum remains persistent. So will you see maybe a potential another rate cut from the Bank of England, or will they get to maintain their rates? There's some time last week but when we saw the governor of the Bank of England, that is Governor Andrew Bailey, give a speech about this as well. So we get to see is the UK economy strengthening? Is it weakening? Do we have steady growth, or is it slagging as well? So these numbers get to tell us what do we expect, but what do we expect from the next meeting by the Bank of England? Will we expect a rate hike or a rate cut, or maintaining of the rates? So let's observe and be patient and see how that unfolds on the next Bank of England monetary policy release. So with that, we come to the United States. We had the Federal Reserve, the FOMC meeting minutes. Now, again, it's important to highlight the difference between the meeting minutes and the actual monetary policy statement. So the meeting minutes usually are used to discuss now the previous monetary policy statement that was released. So I usually see a bit of confusion when people, there's usually a bit of confusion when it comes to differentiating between the meeting minutes and the actual report. So the actual report is the one that comes first. Then the meeting minutes follows later on, because now the meeting minutes gets to discuss what was previously talked about, what was talked about in the previous meeting. So let's see in these meeting minutes, what was the discussion about. So we had the FOMC meeting minutes. The minutes from the July meeting showed divided opinions. So the majority chose to hold the rates between 4.25% and 4.5%, citing upside inflation risks. Then you have dissenting governors, Governor Waller and Governor Bowman. So there is called for immediate rate cuts. So that is the first multi-governor dissent in over 30 plus years. So right now there is quite a lot of pressure mounting on the Fed in terms of cutting their rates. And that has been mainly from President Donald Trump, putting that pressure on the Fed Chair Jerome Powell. So we have what do we get from the previous meeting minutes? So risks to both mandates. One, we have inflation. So we have upside risks fueled by uncertainty around tariffs. Then the labor market, we have downside risks with signs of softening job growth. Then the Fed acknowledged slowing economic activity. We have weaker consumer spending and early cracks in employment data. Then the outlook is that the Fed may face difficult trade-offs in. The Fed may face difficult trade-offs if inflation persists while the labor market weakens. Okay, so with a slower economic activity, we have weaker consumer spending. So definitely, there's also slower purchasing. There is lower purchasing power, and that shows early cracks in employment data. So definitely, that brings about the slow economic activity. Okay, then you have the weekly unemployment claims. So for the week ending August 16th, we had 235,000 initial claims, up from 11,000 from the previous week. Then insured unemployment, you have 1.97 million, which is the highest since November 2021. We have the 4-week moving average, that was 226,250, up from the previous 221,750. So that signals a gradual softening in the US labor market. Okay. Then we have the Jackson Hole Symposium and the remarks from the Fed Chair Jerome Powell. So the Fed Chair Jerome Powell highlighted shifting risks between inflation and employment. Remember, we've talked about when we've talked about the FOMC meeting minutes, we've highlighted inflation and labor risks. So during the Jackson Hole Symposium last week, Fed Chair Jerome Powell highlighted shifting risks between inflation and employment. Then, while the economy remains resilient, we have downside risks are growing due to tariffs and global uncertainty. So we've seen the number of times President Donald Trump has released tariffs and also revised the tariffs as well. So definitely it affects the global supply chains, and it also brings about global uncertainty in terms of markets as well. So Powell suggested that conditions allow the Fed to proceed carefully toward possible rate cuts in September. So remember that September is coming month, the next month. So the next monetary policy statement by the Fed will be closely observed to see will we actually see that rate cut happening. Forecasts are giving high. I mean, forecasts and economists are giving high expectations for a potential rate cut in September. However, we can't give that as the projection until that time actually happens and we see the rate cut happening. So for now, it's more of a forecast. It cannot be a surety. It is more of a forecast, as the pressure has been mounting on the Fed to actually cut the rates. And now you can see even the members of the Fed are now having disagreements about either maintaining the rates or cutting the rates. So the next monetary policy statement is the one to actually watch out for, and now observe the market reactions, because definitely there will be very strong reactions based off this. On Friday alone, we saw when the Fed Chair, when Jerome Powell spoke, we saw markets react almost instantly. There was quite a lot of volatility across all the dollar pairs. So we had very huge very strong movements and huge spikes, and that was caused by the volatility of Powell's speech during the Jackson Hole Symposium that happened. So some of the market reactions we saw from that symposium, from Powell's speech during the symposium was that we saw Dow Jones jumped up 600 points. Again, Dow Jones, that is the US 30, among one of the major pairs that you are looking out for on Friday during the event here. That's why I actually talked about it as the highlight of the week, because it was one successful event. Then you had the 2-year Treasury yields dropped 0.08%. The 2-year Treasury yields dropped 0.08% to 3.71%. Then, so Wall Street widely anticipates a September rate cut. So there is that high expectation or anticipation of a potential rate cut in September. So it's not assured, it's just anticipation. It's more of a forecast. So we can only wait till that time to actually see it unfold, if we will actually get to see the rate cut happening or not. But that is the mood or the anticipation that is there, that we will be anticipating a potential rate cut in September. Then coming into the corporate earnings. So the corporate earnings, starting off with, we'll be talking about Walmart, Target, and Home Depot. So starting off with Walmart, we have the revenue was $177.4 billion versus the expected $176.16 billion. The earnings per share adjusted was $0.68 versus the expected $0.74. The net income was $7.03 billion, up from $4.5 billion year on year. Then comparable US sales, a positive of 4.6% versus the expected 4%. Then the outlook. So the outlook raised, but profit margins squeezed by tariffs, insurance costs, and legal settlements. Okay, so already you can see the tariffs, the tariff effect even spilling onto these various companies. So even when the Fed talks about the uncertainty brought by tariffs, we can clearly see it even spilling into the various companies that you're talking about and reporting their earnings. So we have next in line, you have Target. So we have the earnings for Target as follows. So the revenue was $25.21 billion versus the expected $24.93 billion. The earnings per share was $2.05 versus the expected $2.03. We have the Target announced a new CEO, that is Michael Fidel. We have a new CEO for Target. That is Michael Fidel, who will be that is now effective from the 1st of February 2026. The Target announced that they'll be having a new CEO coming in. His name is Michael Fidel from the 1st of February 2026. Then, despite earnings beat, the shares fell 6% as store traffic remains weak and long-term growth stagnates. Then we have Home Depot. So for Home Depot, the revenue was $45.28 billion, slightly below the expected $45.36 billion. The earnings per share adjusted, we have $4.68 versus the expected $4.71. Then the net income was $4.55 billion, which was steady from last year. The revenue was up nearly 5% year on year. They maintained a full year outlook. They maintained a full year outlook, sales growth of positive 2.8%, and the stock rose 3% despite missing their expectations. So that is what we had for, those are the major events that we had for last week. Now coming into this week, starting from today. Today we do have the GBP bank holiday. Okay, we do have a bank holiday for the GBP. Then we have on August 27th, that is on Wednesday, we will be having the Australian CPI. Then on Thursday, we'll be having the USD preliminary GDP for Q2 and the weekly US jobless claims. So also on August 29th, we will be, that is on Friday, we'll be having the Canadian GDP month on month, and we will be having the USD core PCE price index. So last week presented a mixed global picture, softer inflation trends in Canada and New Zealand. Then you had persistent price pressures in the UK and mounting policy uncertainty in the US. So the corporate earnings season revealed resilience amongst US retailers, but also profit pressures from tariffs and weaker consumer traffic. So looking ahead, markets will closely monitor the Australia CPI data, which is now this week. We have the US GDP and the Fed's preferred inflation measure, that is the PCE, which could set the tone for September's policies decision. So as we start off the week this week, that is what we are looking out for. Let's be vigilant. We will be looking out for the Australian dollar, the Canadian dollar. We will be also monitoring the US dollar as well, as we get to also approach the end of the month and we get to step into a new month from next week. And the new month definitely comes with expectations. Like now we have the anticipation and expectation on the Fed to cut their rates. So those are some of the key fundamentals that we'll closely observing to see, and also definitely their reactions on the various markets that we are looking out for. So with that, guys, I'd like to wish you a very, very great start of the week. So let's have a very fresh and productive week ahead as we get to start off the week. And thank you for joining in. See you on the next one.